Hello and welcome to the latest edition of Citrus Bites from our offices in Sevenoaks. As always, I'm going to take a look at a couple of economic bits of news from the last month. Going to take a little sneaky look forward to a couple of bits over the next month. But most importantly, then, I've got a great guest joining me again today who's going to answer some questions. So let's get straight into it today. What's the news? Well, I guess probably you've heard of this massively around Bank of England base rate. So I think in my last video, I talked about, are we nearly there yet? Clearly, we are getting closer, seems to be the general answer. So the Bank of England Monetary Policy Committee decided to leave the Bank of England base rate unchanged at 5.25%. That was after 14 consecutive months of increases. So really good to see that freezing out. I guess importantly, though, we do that. Well, are they going to start coming down? How long are interest rates going to hold at the current level? That's probably a slightly different situation to be in. The vote was really, really close. In fact, so close, Andrew Bailey, as the governor of the Bank of England, had the holding vote. So it was 4-all. He then cast a vote to keep rates even at 5.25, and therefore we saw a 5-4 majority in keeping them unchanged. So that's where we are today. So what was it in the data that led the Bank of England to keeping the rates on hold at that current level? Well, mainly around the inflation data that we've been talking about every single month. So actually there was good news on the consumer price index inflation gauge. And what was it that made the change? Well, under our CPI index, it was actually overnight accommodation and food that made a big difference in terms of the rate coming down. Again, this doesn't mean prices are coming down. It just means they're going up less quickly. But particularly around milk and cheese. So there we are, they're going up less quickly. And it seems like overnight stays are not going up at the same rate. In fact, they are coming down slightly in terms of price. And then finally, airfares was another one. But the trouble is at this time of year, airfare prices are very, very volatile. So there's a little bit of a note of caution on these numbers around how many of those are going to carry on that trend and how many of those are temporary. And then I always talk about the really important metric being core inflation, because this is the really sticky inflation when you take away energy and you take away food. And part of the energy story has been helped by obviously the change in the way Ofgem and the cap on some of the energy prices. But when you look at core CPI or core inflation, that was even better for this month. So actually, the change was seen at 6.9% on 12-month rolling in the last update to 6.2% in the most recent 12-month rolling. And that's a very positive story, because I do talk about this one being the sticky type of inflation. So what's made the change to that? Well, one of the big differences being brought about by service inflation. What do I mean by that? Well, I talked last time about the pressure being brought on employers when it comes to the average weekly earnings. So average weekly earnings were kind of the highest on record since that data begun. And that's because the number of people available to fill the number of jobs going just meant there's a massive squeeze on the labour market. So not enough people for too many vacancies. That causes a price pressure. Employers fighting to retain and attract great talent means wages going up, and that builds the inflationary cycle. But there was a change in this last month, and the change was that the number of vacancies, which is typically where the pressure is felt, obviously with businesses really trying to attract that talent, the number of vacancies dropped. And that starts to change the dynamic of the pricing pressure that employers are facing to attract talent. So that was a really positive story from an inflationary perspective. So two really good, encouraging metrics when it comes to what might happen moving forward. So the final thing I just wanted to say was, obviously there's no update. I don't have an update yet on the average weekly earnings. Hopefully in my next video, we'll see what the latest statistics are for that. What I will add, though, is there's a couple of bits lurking that we just need to be mindful of and watching very carefully that might direct us to what could happen over the next month's inflation figures. One of those being oil. So if you've not seen this chart before, this is a rolling price of oil, and that's typically called Brent Crude. So there's lots of different oil barrels that are quoted in prices. Brent Crude is one of the most common. And of course, one of the things with oil is it does seem to filter through to many, many pricing impacts. And there's not only motorists to think about. Airlines, the biggest cost they have is obviously bought about through oil. Food distribution, it's all very well the food being kind of produced, but there's cost through oil of producing quite often that food, and then there's transporting it to where consumers purchase it. So oil bears quite an important correlation on some of our pricing. That has been going up consistently for the last 3 months and finds itself at about $92 a barrel today. And that will be filtering through to some inflationary price pressure. So definitely one thing going to watch over the next few weeks. Otherwise, really encouraging numbers in terms of the metrics going the right direction. Positive news, obviously, to see that finally, after those 14 consecutive increases, that the Bank of England base rate has frozen. And look forward to seeing next month to see whether oil has had that dramatic impact or whether we've continued to get towards, of course, the Prime Minister, Rishi Sunak, who has made that commitment in one of his 5 pledges in January. Inflation will halve from its position in January, which means we need to get to kind of 5.5% by the end of the year. So we still have a way to go to meet that commitment for the year end from Rishi Sunak. So that's my brief update for today. I'm delighted to be able to announce this afternoon's special guest, Jonathan Raymond. So Jonathan is an investment manager at Quilter Cheviot, managing investment portfolios for a broad array of private clients. Jonathan attained the Chartered Financial Analyst designation and graduated in economics from the University of Exeter before that. He is married with 2 young children and is from a Welsh farming family. Jonathan, thank you so much for joining us this afternoon. Much appreciated.
Richard, good afternoon. Great to be here.
I will do my very best to kind of give you time. I know you're struggling with a cough, so we'll try and work our way through this as quickly as possible.
Problem with 2 young children, isn't it?
So let's make a start. Going back to your kind of title, really. So probably a good place to start as investment manager. What typically is the role of an investment manager?
Yeah, good question. Some might say I'm still searching for the answer, but the easiest answer is we manage investments for people. So we manage segregated investment portfolios for mainly individuals. Typical sort of range of client sizes is sort of £250,000 and up. It can be across accounts, across wrappers. So, pension funds, ISAs, general investments, trusts, charities, all that sort of thing. And we build those portfolios in line with the client's requirements. So, risk profile, investment objectives, attitude to risk, all that sort of stuff. But as well as other kind of client specific things that go in there, such as, ethical constraints, like maybe no tobacco shares or no oil shares, or maybe the client may have worked at Barclays for 30 years and they've got loads of shares kind of vesting in, so therefore we might not buy them some Barclays shares. So effectively it's a sort of personalized investment offering for those sort of higher net worth clients.
Okay, great. Thank you. So, and personalized, when I was doing some research before today as well, I was looking up the description from Quilter Cheviot's perspective, and they call themselves a discretionary investment firm. And I immediately started thinking, so it's really just for the rich, is it? I mean, is that really the target market for the rich? Or
no,
is it
not really. I know sort of, kind of classic middle England, in inverted commas, I suppose, would be our sort of target market. So our sort of typical kind of entry level is sort of £250,000-300,000 and up, really, and it varies right across the piece from age, demographic, background, professional, entrepreneurs, inherited wealth. Perhaps there's a real sort of mix of kind of clients that come to us. So it's not, the discretionary bit relates more to the fact that we have discretion over the portfolio. So it's not an advisory process. So if I wanted to go back to my desk and buy some Shell for clients, for instance, I could do that because we've got the discretion to act on the client's behalf in line with, the client's objectives and risk tolerance and parameters that we set out at the outset and on an ongoing basis.
That's really helpful clarity. Thank you for that. And I guess it leads me nicely on to, so you talked about being able to go back to your desk. So I have images of an investment manager with lots of screens in front of them, this classic, analogy of, phones ringing and trading and pressurized environments and split-second decisions, things like that. Is that your typical day?
No, not really. But I mean, when I started out sort of 20 years ago or so, we had those phones, those desk phones with the shoulder things on, so you could kind of balance two phones on your ears. Because in those days, whenever you did an order, like, say buying 1,000 Shell shares, you did actually telephone it through to the dealing desk, who were sat 20 yards away over there. So there was a sort of bit of that going on in those days. And I do have 3 screens and lots of bright colors. So to a degree, it's a bit like that, but it's a bit more, everything is done a little bit more orderly, should we say. And we're not turning the portfolios over every day. And if we're going to buy Shell or Unilever or whatever it might be, we're going to own that holding for a very long time in the main for clients. And there's always action and things going on for sure. But we're definitely not kind of buying and selling. We're not trading in and out of the Prudential every 5 minutes. So it's pretty serene.
Got it. Thank you. And on that point, obviously, when you're talking about holdings, certainly one of the questions we receive a lot at the moment relates to cash, and clients saying, actually, should I just be holding more cash? Because cash seems attractive. So what's your stance on the cash question right now?
It's nice to be in a position where we can opt to own not just cash, but lower risk investments like shorter dated government bonds. So, 2, 3, 5 year gilts, which are also yielding 4, 5% a year. We've certainly, for most of my career, since 2009-10, when interest rates fell, cash and short dated bonds haven't really been an option for us because the yields and the returns have been low. So you've had this environment, what's been sort of, what was the term coined was TINA. There is no alternative. You couldn't own cash and you couldn't own bonds. So you had to go out the risk spectrum if you wanted to generate a return of, say, 5% a year. Whereas today, of course, that the environment has totally changed. And I think if there's one thing to stress, that the last 18 months, the world has totally changed in many ways. And this sort of normalization in the cost of money has had and continues to have a pretty profound effect on financial markets and increasingly the real economy as well. So, it's nice to be able to be in a position where clients can hold cash or bonds, because one thing that has been apparent for the last 10 years is that a segment of our client base would describe themselves as cautious investors, the kind of classic cautious investor. Well, because of compliance and because of risk and things, if you're a cautious investor, typically you've shied away from equities and into bonds, but that's not been an easy place to be because the returns have been so low. Whereas today, if you're a cautious investor, conservative investor, you can buy short-dated, medium-dated government bonds and corporate bonds and hold cash and get yourself a not disrespectful return of kind of 5% a year from here. Now, the flip side of that is that if you look at history, you have typically been better off buying equities over moderate to longer term time horizons. My colleague of mine has actually crunched the numbers on this. If you go back to 1985 and you compare the rolling returns on cash over 5 and 10 years versus the rolling returns on equities, you've been better off in equities over a rolling 5-year period, roughly 75% of the time. And over 10 years, you've been better off in equities 90 to 95% of the time. The only times in history when you were better off in cash is when equity markets, when you were buying in when equity markets were very highly rated. And in particular, if you bought equities in 99, 2000 at the height of the dot-com bubble, when it was mania and valuations were very, very high, that was pretty much the only time in living memory when you'd have been better off holding cash over 5 or 10 years. Every other time, you'd have been better off investing, particularly equities and growth assets. And just the final point on that, the other interesting thing about that is if you think back between 1985 and today, and you exclude the last 10 years, for most of that period, interest rates averaged higher than they are today. So the average interest rate was about 6% between 1985 and today. So, if you were better off in equities for most of that time, you'd have to have cleared a high hurdle rate on cash. So just because it means we can get 5% on cash doesn't mean to say it's the right thing to do from a medium to long term perspective. But, to put it really, really simply, if clients have got a 1 to 3 to 5 year time horizon, they're probably better off holding cash and short-dated bonds. If their time horizon is longer than 5 years, they are more than likely to be better off in equities over that time frame. So that's where I sort of stand on it. But it's nice as an investment manager that we've now got the option of owning cash and owning short-dated bonds. And in fact, for a typical client, they now own more cash and bonds than they have done for a number of years, just because we're actually getting paid to own these things.
That is a really helpful answer. Thank you. And great context. And well done to the person that sat there working back to 1985. Amazing things they've done.
It's done some number crunching in Excel, but it surprised me. But it sort of makes sense if you think about it, because what is an equity? It's an investment in a business. And someone's got up in the morning and they started up a business with the promise of getting a return better than they could do on cash. So if you weren't going to get the returns, you wouldn't start the business in the first place. So there's fundamentally a very good reason why equities, i.e. company shares, do better than cash. And it's that risk reward thing. And that's how I sort of try and think about it, really.
Yeah, nicely put. Thank you. And I guess you talked a little bit there about what's happened over as well, kind of since 1985. We also talked about .com. You talked about, that really low benign interest rate period from the financial crash. So from the UK perspective, Jonathan, what do you see playing out from an economic perspective over the next 12 months? Can we avoid a deep recession in the UK? What do you see as happening?
It's a really difficult one, because had you asked me 6 months ago, I probably would have said that the resetting in people's mortgage rates would have had an impact on spending and the economy would be slowing. And dare I say, it's not quite played out as I might have thought 6 months ago. There's a reason for that. Some really interesting statistics which sort of surprised me. Of all of the houses in the UK, only 33% are owned with a mortgage. So 67% of the households are not subject to a mortgage at all. If you take that 33% of households, 90% of those households have a fixed rate mortgage of some description, 2, 3, or 5 year, mainly 5 year. And so then if you think about that, each year, only a very small proportion of those mortgages or those households roll off that what has been a cheap fixed rate onto a more expensive fixed rate that we're looking at today. And the number of households rolling off cheap mortgages is about 400,000 a month, which is roughly 1.5% of the households in the UK. So on a month-on-month basis, there are a number of people who are going from paying, say, £500 a month, and they're now paying £1,000 a month, or whatever the numbers are. But it's quite a steep rise. But the numbers of people that's happening to is relatively limited, because A, most people own their home or rent. Renting is interesting, and I might come back to it. But and B, they've got longish term fixes. And if you're lucky, like Mr. and Mrs. Raymond, you've got another couple of years before you need to worry about a fixed rate, roll off. Whereas a couple of colleagues have already had to go through that, and it's a bit of a sting in the tail. So, there is a sort of element of, and many of your kind of viewers and listeners might remember the early 90s episode where interest rates went from kind of 7 to 10 to 15% overnight. In those days, 45% of the houses had a mortgage, and 90% of those people had floating rate mortgages. So the day that interest rates went up, everyone's letters dropped on their doormat the following day. Well, you can imagine, what that did for sentiment in those days if so many people are seeing a huge rise, which is just not happening today. So there's some really interesting stuff in terms of the structure of the mortgage market and the property market that makes the pain kind of slower bleeding, if you like. Now, we still think that has an impact, and we don't think that the economy is entirely immune from these steep rises in interest rates that we're seeing. Businesses are in pretty much the same position, whereby if you borrowed some money to build a factory or wherever, or expand, that's probably on some sort of fixed rate term that's probably going to expire at some point. So there is going to be a squeeze coming, and there is a squeeze happening, but it's maybe not as pronounced as many thought. So on that basis, the economy has so far pretty well withstood what's happened in terms of base rates, but it's probably not entirely immune. And I think our base case, and I think our base case is that the economy does slow next year, and there will be an element of recession of some description, but it's not, it's by no means a kind of done deal.
Brilliant. Okay, that's a really, again, a full answer. So really appreciate it. Thank you very much. You now get the great job of being able to answer the question set by last month's guest, Jonathan, who was Sarah Batters, actually. So Sarah is a local mum, football coach, previously a commercial director at a football club. And her question was, so who was going to be next to win the World Cup? Would it be the England women's football team or the England men's football team? So there we go. Slightly different question this time. So would be great to get your thoughts on that one.
Yeah, well, as you alluded to earlier, I am actually Welsh, so I'm a sort of, non-partisan member in this debate. Clearly, we've seen the men's football team probably flatter to deceive a little bit over most of my lifetime. I sort of remember the Beckham, Gerrard, Lampard era when, what a great side on paper, but just, never turned up for tournaments, and you just sort of wonder. The current crop of players, look pretty strong on the men's side. I don't profess to know huge amount about the women's game in terms of the relative strengths, but clearly they've had a good crack at it, this time around. Excuse me. And on that basis, I do think actually in a strange sort of way, having the women having won the Euros, my hunch actually is that the women probably get there first.
Perfect. Thank you very much. Well, it depends how long we'll have to wait to prove you right or wrong is probably the big question.
Well, that's right. Yeah. Well, who knows?
And then, Jonathan, would you be kind enough to set a question for next month's guest, please?
Yeah, sure. And I've got a sort of a multiple choice question for next month's guest, and it revolves around which asset or investment they would like to own for the next 12 months. And the multiple choice answers are equities, so a broad diversified global equity index, bonds, fixed interest securities, cash, or gold. Gold is my fourth answer. And all four asset classes are really interesting. Obviously, we've touched on cash and short-dated bonds. We've talked about equities. We haven't really talked about gold, but I'm not by any stretch a kind of mad gold bug like you see around these places. But I think with the world the way it is, it's going to be a really interesting 12 months. And I think, as ever, what it comes back to is diversification, eggs in baskets, trying to diversify our risk away. And I think it'll be really interesting to see which of those four assets do the best over the next 12 months. I don't think it's an obvious answer.
Brilliant. I should look forward to posing that question to next month's guest. So, Jonathan, look, I really appreciate it. I know you're busy, so thank you so much for sparing the time today. Very much appreciate it, as I say. So thank you. And that's all I've got time for today. So thanks ever so much for watching. And next month's Citrus Bites is going to be slightly later. So we're going to be into kind of the second week of November. So a little gap before the next one. But thanks very much indeed. Take care. Bye for now.